Alrighty, good afternoon everyone. I am the moderator for your Renewable Energy Finance panel, and I am an MBA MEM Master of Environmental Management student here, and I'm studying energy finance. So I've been looking forward to this panel for a very long time. Joining us today, we have Noah Hyte from Cypress Creek Renewables. We have Apolka Totth from Conveyance Capital Partners, and we have Matt Eastwick from CleanCapital. I'm going to let each of them give a brief introduction about themselves, and then I'll jump right into questions. I'll leave a couple minutes at the end for audience questions, so please use the link on the slide above me to submit your questions. So Noah, will you kick us off? Tell us a little bit about yourself.
Sure. Noah Hyte from Cypress Creek Renewables. I lead market development and business development for Cypress. We are one of the nation's fastest growing solar and storage developers and active nationwide. We really got our start here in the Carolinas and thrilled to be here today.
Hi, Apolka Totth. I work at Conveyance Capital Partners. I got my start in project finance and moved into development from there. I've sort of sat on all sides of the transactions, including tax equity, debt, greenfield development, and acquisitions. Conveyance Capital Partners focuses on utility scale projects over 100 megawatts, and we acquire, develop, and finance these projects in concert with our partners. So.
I'm Matt Eastwick. I'm the Chief Investment Officer at CleanCapital. And first of all, thanks to Jenna and the Duke team for hosting us. This is a great conference, met some really amazing people, so thank you for having us here. So CleanCapital is a little bit of a unique firm in the clean energy space. We're really a financial technology platform that's making it easier, quicker, and more accurate investments into renewable assets, mostly smaller scale. So it's a difficult space for folks to invest in historically. So we're using some of our financial technology expertise and software and build out to make it easier to invest into the space. And we're starting in operating solar assets, so small scale, a few hundred kilowatts to a handful of megawatts of individual project size, and aggregating that up alongside our equity partners, which are some of the largest financial institutions in the marketplace.
Great, thank you guys, and thank you for being here. All right, Noah, the first question's for you, and then Apolka, Matt, please feel free to jump in. What emerging off-taker trends are you seeing, and what are the issues and considerations you're facing, and how do you overcome these?
Sure, so I should kind of preface my answer in that we are active in sort of the ISO RTO, wholesale market utility scale space. We're active in R&M and community. We're one of the largest developers in community. And then also more traditional PPAs with utilities and sort of C&I. And I think a lot of what we're working through is hedging, increasingly for solar. Most of the hedges to date in renewables have been executed for wind. And with wind, it's less focused on shape. For us, getting to good models that are bankable around sort of time of day and time of use, and structuring, since there's only been a handful of hedge deals done previously in solar, and working through that is challenging because a lot of the solar professionals have been more focused on other forms of offtake. I think the other area where we're seeing a lot of growth and a lot of opportunity is working with retailers. There's been a fairly large trend towards sort of commercial and industrial offtake, but working with retail energy providers and folks on full requirements products and other products that are a little bit different and sleeve through some of these retailers has been a great opportunity for us, and also helps manage some of the credit issues we see with some commercial off-takers, where they could be a Fortune 500, but they could still be below investment grade credit.
Yeah, just to add to that, I think that the market overall has evolved as well, where you could term it traditional project finance required every box has to be checked along the way. So it wasn't, it was the fact of life going back a few years that if it didn't have 100% investment grade offtake, that it was not bankable or not financeable. And so we're seeing trends in the financial structures to allow for baskets or buckets of non-investment grade or unrated credits as well in the financial structures. And then as Noah said, I think there's just more of an appreciation as to what the underlying credit looks like for an energy off-taker. It's not the same as borrowed money, so it's not the same as a pure credit spread, where there is a need for procuring electricity. Usually, or in most cases, I'll say, people pay their bills. So it's a different credit analysis, I think, and that's helped to build the market up as that becomes more appreciated by everyone involved.
All right, Apolka, the next one's for you. What are the trends and implications of developers signing fewer power purchase agreements or PPAs with utilities and more PPAs with community choice aggregators or CCAs and corporate customers?
Yeah, sure. So over the last 10, 15 years, we've seen, I think as we just mentioned, a large shift in the type of off-taker. Before you'd have a utility as your counterparty, and you could count on a 20 to 30 year PPA term. And I want to stop there because term is very important when you're project financing a project where all the capital costs are up front. With CCAs, with C&I customers, sometimes you do, you can get a shadow rating, or you'll get large public companies like Google and Microsoft in the room, and those are a little bit simpler, I would say, to have as a counterparty. But with these different type of arrangements, developers are having to take on more risk, such as basis risk, firming and shaping if that's a requirement in the contract. And I think that comes with its own, unique challenges. We can sort of look out on the horizon and try and guess what's coming. One of the big things that's going to happen in the next 3 to 4 years is that the tax equity will sunset. And so once you remove tax equity from the capital stack, you're going to probably be driven towards shorter and shorter durations, much more like your conventional fuels like natural gas, as they would interact in the wholesale market. And that is sort of a moving target. A lot of renewable energy developers grew up in the world of a great single credit off-taker as your counterparty, and now we're having to be a lot more lithe and mobile around the changing markets. So.
Yeah, I think I would echo the tenor thing that Apolka touched on. When we started doing 10-year deals a few years ago, people thought we were crazy and didn't think it could be done. And I think the last vestige that's holding any sort of reasonable argument from us when you compare us to thermal is sort of the recapture period and what you're looking at on tax equity. So it's probably good and bad in some ways because it's going to force everyone to be more flexible. But at the same time, too, contracted revenues look a heck of a lot better, and it's easier on debt coverage ratios, and it's just easier for us to package. So I'm pretty torn on it. Because it gives us a leg up, but at the same time, too, it should make us more flexible. Mm-hmm.
And just to add to that, too, I think you're seeing it also, the evolution of the way that costs have been reduced in upfront costs in building renewables. It's really made an impact as well. So when it costs you $5 or $6 a watt to build a solar project, which is not too far in the distant past, you had to have the term, you had to have the tenor, you had to have a very high price PPA in order to support those costs. And now we're so far down the cost curve that you're able to do different types of revenue structures and revenue terms. And so it just becomes more competitive with the overall market, and there's less of a hurdle to overcome.
Yeah, absolutely. And so Noah, as a developer building off of that, and the tenors are getting shorter, how do you guys stomach that risk? What kind of justifications make it all right for you guys to take on the shorter periods?
I think it depends upon the market. So we're in a few different markets. We're in community, and in community, the tenors could be 12 months. And there's some fundamentals there, whether it's a business or whether it's a aggregated pool of residences or sort of residential users, that you can replace them, that you have savings, that there are inherent advantages to the tariff that they're under, that we need to get folks comfortable. And kind of that's been one area, because we're a big community developer where we struggle. I realize that we weren't asking specifically about community, but that's one area where we're really challenged, because the average financier of community treats it more like rooftop, where the inherent risk associated with default is higher, but the impact of that default is lower because you can replace the customers. So that's one challenge that we've got right now in community. I think a lot of community folks have, because it's not resi, it's more like syndicated consumer credit overall, and it's something that you can revolve around. So there we're working hard to show usage history, default history, a late payment history, and to be somewhat choosy about folks. On the larger projects, it's building a case that lenders and that investors, whether it's sponsor or tax equity, can get behind. Tax equity is less of an issue because we're typically covering them. But in various markets, addressing that solar plus storage, repowering, ongoing capacity revenues could potentially bolster tail. A lot of those different levers are different things that we're doing to show that on peak or peak coincident or near peak coincident, and then with the potential to add storage or integrating storage now, provides multiple streams of revenue over the life of the asset that are more reliable than booking just energy revenue alone.
Yeah, absolutely. All right, Matt, it's your turn. So you mentioned CleanCapital does a lot with technology. So how do you see financial technology impacting renewable investment in the future?
Sure. The technology is something we're very excited about at CleanCapital, and implementing the ways that the broader financial technology market can be applied to this part of the industry. So technologies really transform financial services in almost every segment of our industry over the last few years, but it hasn't really gotten a hold into project finance and renewable investment. So our approach is to build a platform that then facilitates the investment into the asset class. And because there's so much contractual information to go through, because the industry itself is relatively young, so there's not a lot of data sets behind it. So we're using all of that to really become smarter, quicker, more robust investors into these projects. So, and we're not alone, obviously. There's a lot of folks that are innovative in data and analytics as well. That's really interesting. So there's firms that have taken the data sets that have been generated by a few years of solar production or wind production, and are able to create either financial products or other types of ways of utilizing that information, and increasing the financeability of projects, and also increasing the knowledge and use of that information by the broader market. So there's a lot to do. I think there's an interesting play in a number of different factors or a number of different ways to use technology in the industry. And I think we're going to see a lot of change here in the next few years as it comes on. I mean, I've only been in the industry since about 2010, which is might be the newest person in this on this panel as far as that's concerned. But you've just seen a sea change in the approach as well, and technology's impacted that. So when independent engineers were doing their solar reports or their wind reports earlier in the industry, they didn't have a lot to go on. They still did a pretty good job, but they didn't have a lot to go on. Now you can be more precise and more analytic about what the production's going to be, how the revenue streams are going to behave, and that just makes everything more financeable and bankable.
All right, Noah, what are the main issues and considerations you see in investing in small-scale distributed energy, and how do you overcome those?
You know, for us, it's a few things, and this isn't necessarily specifically project finance, but I think that it's applicable sort of across the board, from development to operation of the facility, to the sponsor position in some of these facilities, to the offtake and contracting, and then all the way through financing and transactional costs associated therein. And it's finding the right denomination, you will, of megawatts and of investment, and bundling them appropriately for whomever your repeat investors are, or for the entity size that's appropriate. Because without a doubt, DG and sort of behind the meter and some of the smaller scale investments on a one-off basis and going through transactions on a one-off basis they're not infeasible, but they're significantly thinner. We've had some success by both in sort of QF markets, community markets, some limited behind the meter, tranching stuff out in similar risks, meaning not all DG is the same. Rooftops should probably be bundled together. Brownfield should probably be bundled together. Greenfield community is different than a QF DG play. And so finding investors that are aligned with a specific kind of risk, and then sizing portfolios appropriate to their needs, and trying to make it repeatable, both in terms of efficiency of scale in an individual portfolio, but then doing multiple portfolios that are relatively homogeneous. That for us has made things scalable, repeatable, and there's less brain damage associated with each and every deal.
Yeah, totally agree. Like, the way to get the aggregation is key. Like, so to make things as easy as possible to continue to build and aggregate on a small scale. I mean, no one is going to just invest in, you know, a single, say, 1 megawatt asset and just stay there. It's infeasible. The transaction costs alone are going to swamp any type of return profile that you could create there. So, you know, creating, you know, on the new builds, creating as much uniformity or homogeneity as possible is important. From our approach, we actually are acquiring assets that have already been built and are operational, and so we're not able to make those types of adjustments. We're inheriting what was already put in place. And so another way, again, going back to the technology theme, is being able to assimilate this information, even if there is, you know, a diverse set of facts, and be able to analyze that and also then package it up for easier investment that way. But the market also has just grown so quickly that there is a lot of niches and a lot of different types of projects. And so if you take a big picture approach and are able to, you know, to handle, you know, any situation that comes your way, that also is a big advantage for those of us that are, you know, into this, investing into this space.
And is that a trend you all have been seeing, that the projects are getting smaller over time, or are there just now two sets of large projects and smaller projects?
I mean, I look at it as two distinct worlds. You're either doing utility scale, and in that case, the larger you are, the better it is, or you're doing very small projects. And again, the gentlemen have already hit on the topics, but you've got to have, you know, portfolio, repetitivity, master agreements, and uniformity to get there. But
I mean, I think there's a little more digestible thing in the middle with some of DG as, and this is again on the, you have to forgive the developer in me, but like as grid integration has gotten more sophisticated, and as utilities or states have programs or are willing to work with us, the size of some DG in community and in QF markets has been creeping up for solar. And, you know, particularly if you add in storage, your average check size could be getting close to 10 to 15 million. And that's a lot better scale if you put a few of those together than a bunch of 750 kilowatt deals, and there's like 10 of them, and you only got to 7.5 megawatts. We're talking like a check size of $10 million for that many deals. So I think there is a little bit of a trend there that for us, we're excited to develop in and we're excited to finance because it's a little bit chunkier. But yeah, I definitely think that generally speaking, the asset classes are different and the cash flows look really different because your average small scale, behind the meter, or DG, whatever it may be, on the lower end of the spectrum, typically needs a higher revenue rate to justify the lack of economies of scale associated with it. Whereas you're more so betting almost on a manufacturing facility when you pick up a large scale wind or solar project, and the levels of mechanical availability and like all these other things are very different, and they're kind of two different asset classes.
Yeah, and I would say they're competing for almost two different sort of revenue streams, one with the wholesale and one with the retail rates. So you're sort of taking a bite at two different sort of revenue streams.
I agree.
All right. And talking about different asset classes, what type of energy assets do you see as having the highest growth potential in the future? And what is driving that growth, and what are the hurdles to that?
Who's that direct at, Jenna?
Anyone, but you know what? You.
I agree. No.
Cool.
So, sorry, the question was about what's the most exciting for growth in the industry? Yeah. So I think, just even the past day or two here, the common topic of conversation has been around storage and the way that storage can transform, especially, solar-related assets. So, the broader themes of where, how you can optimize intermittent resource like solar or wind is, if you were just sort of map it out, with a blank piece of paper, you say, well, let's have some storage involved with that. So the ways in which storage is going to transform the market and is already starting to, I think are the most exciting, parts of the industry, and that we're going to see the most growth. I'm sure there'll be some bumps along the road, but that's where we're most excited, and we're spending a lot of time focusing.
I think the other piece on storage that could be pretty interesting is we're seeing like this massive wave, and there's only a few groups doing it, but massive wave of repowering in wind. And that hasn't really started in solar, but when it does, it's absolutely going to integrate storage. And I think from our perspective, solar plus storage, for us, it's super dependent upon the tariff and the market in which you operate, but I can't imagine deploying solar after 2020 and it not having storage. And a lot of, depending upon the market, in the Northeast, in the Southwest, certainly the majority of projects going forward, even in 2021, 22, will have it, but it enhances the profile of the project so much. And with ITC eligibility of storage, when you deploy it with solar, and the cost curves on storage, it's going to become more and more ubiquitous in terms of optimizing shape, dispatch, and resilience of solar on the grid.
I agree with storage for sure. I think in this country, and at least in North American power markets, we're overbuilt by about 30%. So we don't need new storage per se. We've got plenty of natural gas and coal and other assets that would do that job. So for me, it sort of comes down to how quickly can you get those assets to retire. We've got a lot of noise right now in the wholesale markets that I think is going to get louder, if you will, with more and more sort of assets. In California, we've got the duck curve, we've got, negative pricing midday at times. And so solar plus storage will be a huge help in that. But I still see, we'll kind of see where gas is going, but renewables and gas are really the only two things that will get deployed. I think we've seen the end of coal getting deployed as a new asset several years ago. I think was the last one. And so I'm excited to sort of see where and how the industry grows fastest. And waiting, I guess, for storage to grow up a little bit. With respect to, you've got about a 10-year life cycle on storage. So you've got a lot of projects being bid in. Cost curves are, expected to continue declining like we saw for solar, but we're seeing 30 megawatt projects and 50 megawatt projects, and we're trying to replace 2,000 megawatts at a time of retirement. So that in our play to me is really interesting. So I look forward to seeing a little bit more of that I've heard companies express some concern about lithium ion, so I'm looking, and that is the most viable storage that we've got right now. But I think if you look at the life cycle of lithium ion, there's some big question marks around that technology.
Yeah, I mean, I think in most of what I think we're discussing is storage paired with renewables. What I find interesting, and I'm very interested to see what happens over the next, 3 to 5 years, is a lot of the standalone storage that's gotten built has not been financed in a traditional way that a lot of renewables or other power generation are. It's been largely balance sheeted. And every time I get on LinkedIn, I see 5 more people who are either wind developers or solar developers, and they're standalone storage only developers. Yeah. And I'm like, awesome. Like, that sounds like the bleeding edge, and it's very cool, and it's exciting, and that's gonna be great, but I don't think that many deals, and I'd love to hear what you guys think, on standalone have gotten done with debt and have gotten to a place. I mean, it's one thing if in California, if you contract it and it's essentially a tolling agreement the same way you do a thermal plant, that's relatively low risk, and you may be able to get a CCA or a load serving entity to do that for 15 or 20 years. But to have a plant that's optimizing maybe some ancillary services, capacity, and some demand response, a lot of that get financed. I don't think we've really seen that, yeah. And I think maybe the development community is trying to be out in front of it, and that's great. But I think it'd be interesting to see some of those trends, because it's going to require more sophistication than most renewables financiers, I think, have had to use, and it's going to look more like thermal in the way that you have to monetize a lot of different revenue streams.
I mean, when I go on LinkedIn, just a bunch of cartoons people post pop up, so they must think you're much more interesting than me, Noah. the algorithms on LinkedIn must think much more highly of you. But I know, to pick up on the theme of the financing structures and the financing innovation, I mean, that's where we're going to also see a ton of value be created in the industry. So it's pretty typical to see, new asset classes be on balance sheet, and then we figure out how it becomes more broadly syndicated or off balance sheet, or whatever it ends up looking like. So, for instance, the residential solar market has been transformed by securitization. So the lower cost of capital, the way they're bundling the assets into the securitized markets, it's transformational for how that industry can then grow and build. So financial innovation is really important for this industry, and I think that's what you're going to see in a lot of these emerging asset classes is, continuing innovation for financing structures and ways that these assets are then built and invested into.
All right, Apolka, what are some of the key considerations with trends of extremely low PPA prices? We've seen that a lot in the news. We have very low PPA prices when we have rising interest rates.
Right, so to start to set the table right now, we're in an era of very low interest rates, although we're getting a little bit of, the Fed's raising the rates. But what's happening in North America right now is we've had a plethora of Asian and European money, seeking yields and seeking the risk-adjusted returns here. And so bank debt right now is extremely available, extremely cheap. But the question, and a lot of the deals, I'll just add that a lot of the deals, I think for solar, they're pricing at 6.5 to 7, but that's based on a 35-year life, useful life of the asset. Whereas you're getting a lot of, I guess, the lowest price PPAs that I'm hearing are coming out of the load serving entities, where you'll have, I think Excel's RFP last year had something like 58,000 megawatts bid in, and 1,800 megawatts awarded. So you have a 2 to 3% chance, which is sort of a daunting way to wake up in the morning as a developer and say, I can put my best foot forward. I'm selling a fungible good, and so price is pretty much my only lever. How low can you go? And then inside that deal, you've got rising land costs usually, you've got rising O&M costs, you've got your reserve accounts for inverters, et cetera, replacement of equipment. That if you just get a, $20 per megawatt hour, I think is what is now coming out. I've heard even lower. It's a bit of a hair-raising proposition in the long scheme of things, because you're having to really say, I can refinance, after usually you'll do a hedge in these cases. And so, then you're really taking a bet on what those power prices look like in 25 years. That's a big bet. It's not an easy bet to take. Especially if you look at historically, if you look at what power curves have predicted and what power curves have delivered, tends to be, a differential there. And so I think a lot of people are taking a lot of bets, and it will be interesting to see what that looks like if we do get rising interest rates, which at some point we might. So, yeah.
I mean, if you're, and I've never been a banker, so take this with a grain of salt, but if I'm lending and the debt doesn't match the PPA tenor, I'm going to want to know why your wind project or your solar project is different than the next one. Or if I'm an equity investor, why is it like, are you deploying storage earlier? Are you deploying bifacial tracking before anyone else is? Are you on a better node, closer to population? What advantages does your project have that you're going to somehow extract an above market rate in liquid markets? And why would we want to invest here? And I think a little bit of it is challenging. I mean, as a former wind developer, we saw wind prices go down. I don't know that we've seen like a single digit wind price yet, but I bet at some point, like phase 4 or 5 of a wind project is going to do it. And that's wild. For us in the solar industry now, it's more about what is your fundamental belief in the cost curve, and then when I say that, I mean in panels and storage, and how does that meet where you think the power market's going to be? And I don't know. I mean, we've experienced such incredible cost reductions that it's hard to imagine we're going to continue to experience that. But I don't know. There's like some sort of test of belief there on both revenue and capex to make you believe that for some reason you can do it. And maybe some really, really cheap capital from China or from Europe helps you do that. And if you have super low hurdle rates and you get a long way there during your contracted period, fine. But it's becoming, in these public solicitations, it's becoming incredibly challenging given where some of the pricing's going.
Yeah.
Yeah, just broadly speaking, this is all the issues that we've just talked about aside, it's still a relatively stable asset class as well. So, there's fairly predictable cash flows, whether they're contracted or not contracted. All the bulk of the expenditures are up front in CapEx. So lenders actually, I think, are, if structured correctly, you're going to get your money back, almost every single time. It's just a matter of, making sure that you're not going too far overboard in terms of the types of technologies that you're lending to, the types of even the developers are solid, but the asset class itself is going to generate stable cash flows versus most of the rest of the market. So, using that as a baseline, you can't overextend yourself, but it's a pretty solid place to lend into if it's understood well. And interest rates are somewhat of a factor, I would say, but most of this industry is financed with fixed rate debt, or it's swapped into fixed rate debt. So you're not exposed to the rise or the spike of short-term interest rates with floating rate exposure in most cases. So once the deal's put in place and the rates locked in, then obviously there could be some change, but there's not a huge risk that's associated with that either.
I mean, I think there is risk though in the development phase, right?
Development phase, correct.
If you're signing a PPA today for 2022, and it's a sub $20 solar PPA, you're taking multiple bets. You're betting on the cost curve, you're betting on forward pricing, and you're betting on interest rates. Mm-hmm. Once it's operating, yeah, it's de-risked a bit.
Yeah, I got to spend more time in the development world, I think. I'm missing those.
It's fun. You'll win 1 out of 100 times.
Exactly.
You try.
What's not to love?
All right, I'm going to move into some of the audience questions. Going back to our battery storage conversation, for battery storage, how do your firms model out revenue streams when regulations may change in the future and allow for more services to be provided?
Who wants to go first, sir?
Why don't you start us off?
I mean, so there's some things going on that aren't our friend, like the MOPR proceeding in PJM, and I feel like I'm about to devolve into a lot of acronyms, so I'm going to try to avoid doing that. I'll speak broadly. Some of the proceedings going on in some of the wholesale markets right now around capacity and around the interaction between state mandates, state incentives, and then the deployment of renewables. And then the current makeup of FERC are challenging when you're trying to deploy storage and you're trying to tell investors, we can project capacity revenues just as well as we can project energy prices. Just like our forward power curves, there's forward capacity curves with varying levels of efficacy. So I think it's challenging. I think saying that either power prices are going to be high, and there's going to be high arbitrage between peak and on-peak and off-peak, and solar's going to help you leverage that, or if power prices go to zero, we're going to have very robust capacity pricing, and storage will help you leverage that, is a great story to help buttress the financeability, but I think it's still somewhat challenging given some of the headwinds right now and in sort of the twilight of some of these thermal units and how different industry lobbies are affecting different rulemakings.
Yeah, just to kind of pivot a little bit there, one of the big issues that we touched on a little bit on storage is the actual software that's being used to deploy the storage asset as well. So when you look at integrating storage into the different markets, you're actually relying a lot on somebody's prediction on what the price is going to be in 15 minutes or an hour or whatever the algorithm is going to look at. And so that's got to be right. And that probably has to be right and then change when the market changes and changes again. So the way that storage is used in demand markets and in other arbitrage type situations is very, very software driven and AI driven, and so that's tough, at least for me, to completely get my arms around and understand what that all means.
Yeah.
All right, going back to our corporate customers conversation, how do the corporate off-takers minimize their risk, and how does does mitigating risk become easier with corporate aggregating the deals?
I mean, I think we're painting with a broad brush, and we did it to start with, so maybe I'll color in a little bit. But not all corporates want the same thing. Mm-hmm. Yeah. Some corporates have energy as a key input to their cost of goods sold, and those kind of corporates aren't powering the lights in their office per se, but they're powering manufacturing or servers or whatever it may be. And so I think typically those kind of corporates are more sophisticated and look at this as a commodity that they have to manage. Mm-hmm. And they likely, because it presents such a large portion of their overall costs, have some sophistication and have brought people in-house that can help do that. Other corporates are simply focused on additionality, and they want RECs, and they're happy to lock in their power price, but it's 1% of their overall cost to run their business. And so they more so just want to be risk averse. They don't want a lot of commodity exposure, but they want to provide either what investors or their board or other folks or even their employees have had. And so I think different kinds of corporate off-takers want exposure and opportunity or protection from some different things.
Yeah, no, I think that's right. I mean, I think the difficulty or the challenge with corporates is that you just have so many different types of corporates, like Google has, wholesale rate authority, Apple has a deep energy team. That's Google and Apple, that's wonderful. The rest of the corporates would, certainly sort of shakier credit ratings, or the inability to firm and shape their power, or they have to still, they still have to work through their retailer. That's difficult. Regulation across the U.S. is very, very different from state to state. So whereas you can have direct access in Nevada, which is sort of a poster child for servicing C&I, you get to the Southeast and you've got, you've got the IOUs, the independently owned utilities in charge, and you can't sell power to their customers without sleeving through them. And so you have 50 different solutions for 50 different problems. I think for sure, for a developer, I think the types of risks that we have to take when working with corporates is just harder and more difficult. Gone are the days where you pick your point of injection, which equals your point of delivery from the utilities perspective. And so you can go ahead and just bid in your price, model your project, worry about all the other risks. Now you're having to take development risks, you're having to look at accounting treatment issues, how you're looking at derivative accounting. And so you've got just on basis risk alone, you've got a huge amount of risk that you as a developer are taking. So then and then the corporate's sitting there saying, you have to take this basis risk. Well, no one can price basis risk. That's an impossibility. It's ever changing, and it's very volatile. So then you have to put up credit facilities. Again, the burden comes back to the developer, and it drives you towards more sophisticated, better financed developers versus 10 years ago where two guys with a laptop and a smile, as we used to say at a bank, would come up to you and say, here's a great project. I just bid it in. I just signed it for $180 a megawatt hour, and everything's great. So those days are long gone. And so the industry's just getting a lot more sophisticated, and I think that's a good thing.
I think, too, the tech companies that Apolka mentioned and then have hired a lot in-house, and they've become extremely sophisticated. But your average C&I that's going out and doing this, maybe they don't have the expertise in-house, but they're paying handsomely for that expertise. And this market has turned very much into a buyer's market. Most of the risk has been pushed onto the developer or asset owner, downward pressure and margin compression. There's a lot of things going on where there's a lot of projects, and there's only a few of the highest grade, longest tenor or longer tenor offtake, and then you're scrambling for other things. So I think most C&Is, once they make up their mind what they want and what motivates them, don't have a hard time finding someone to sell it to them. I think the challenge for the development community and the financing community is how low can we go, how far can we go to accommodate them without making projects unfinanceable or unattractive financially.
I also think that from a corporate perspective, there's been this reputational transition as well. So it's a lot different when Noah shows up saying, "Hi, I'm with Cypress Creek. We've just done however many gigawatts you do a year. This is great. Look at my credentials, look at my references, et cetera, versus Hyte Industries or Hyte, developer co. knocking on his door and not having that type of ability to show that this is going to work for the corporate as well, versus the status quo, which is, that's an easy decision for someone to make, just sitting in that chair to say, I'm just going to continue to buy what I've buy from the utility, and we've done this for forever, and why change? So I think that there's been a growth in the type of developer, and that is healthy for everybody who's transacting in the market.
Yeah.
Yeah, absolutely. I think we have time for a really quick one. All right. Going forward, what do you believe is the greatest source of risk for investors in the renewable space? It's a big question, and you have very little time.
Cold fusion.
I think it's going too far too fast. I think that there's still a lot of rapid change in the industry, whether it's technology or whatever, and you have to make sure everything is understood and not kind of over your skis. So the way that the industry's gotten in trouble is with things like yield codes and stuff that didn't really make a ton of sense when you sat down and went through it. So making sure that we're not going too far too fast, my answer.
Oh, so many things. No, I think just the power curve. I think it's probably a function of how successful renewables have been. Every time you deploy something that hits the grid at $0 per megawatt hour, you're going to cause wholesale power prices to continue to come down. So it's sort of, as we're more successful, the challenge of trying to price that power curve becomes much harder.
I'm going to say internal combustion engines because, Ford's not going to make sedans anymore. There's a lot of potential load and electrification coming, and delay in that is going to affect load growth or bolstering the lack of attrition that's already occurring through energy efficiency in a lot of markets. And I'm very bullish on electric vehicles. I cannot wait to not have to drive places. Just enjoy conversation instead of yelling at people in LA. But the faster that happens, the better it is for us, because we're going to deploy the resources to meet it, and delays in it, to me, potentially, particularly in markets like California where there's already been a lot of renewable penetration, but really in a lot of other markets as well, is something I'm counting on. And if it's delayed, it's not going to be good for us.
All right, great. Thank you guys so much.